Good morning, everyone. Welcome to our weekly research morning call. For today, we have quite a few stock counter updates as can be seen and our usual Singapore weekly. So without further ado, let me pass on the time to Natalie for Keppel DC REIT.
Thank you, Vivian, and good morning, everyone. So starting off with Keppel DC REIT's first half 21 results. So from the table, we can see that gross revenue grew by 9%, MPI 8.4%, and then of course your distributable income and DPU grew by about 12.4% and 12.5% respectively. So all of this was driven by the acquisition of Amsterdam DC and Kelsterbach DC, which were acquired in December 2020 as well as May 2020 respectively, and contributions from AEIs at Keppel DC 5, Dublin 1, Dublin 2, as well as DC 1. Okay. On the positive side, during this first half results, Keppel DC announced the sale and leaseback of Guangdong Data Center for 143 million Singapore dollars. So this is approximately a 9% NPI yield and will provide a 1.9% DPU accretion on a pro forma basis. Okay. So this Guangdong data center is the first of 6 data centers that have been developed by the developer within this Blue Sea Intelligence Valley Mega Data Center campus. Okay, so the remaining 5 assets, KDC will have a ROFR on the remaining 5 assets, which are currently at varying stages of fitting out. Yeah. Okay. So this Guangdong data center is actually located within in Guangdong province, which is part of the Greater Bay Area. So the second positive would be the 5.3% of leases that were signed during the quarter at positive rental reversions. And also there's a potential divestment of Aztech Data Center, which is located in Brisbane, for 35.3 million Singapore dollars. So it is a potential divestment because Keppel DC has granted its underlying tenant, which is Aztech Private Limited, an option to acquire this asset. And this option is valid for 5 years and is exercisable from the 1st of August 2021. On to the negatives. Of course, we know that there was further cap rate compression. Competition for this asset class remains stiff. Cap rates have been compressed by about 50 to 75 basis points from a year ago. So cap rates now stand at around 4 to 6%. The silver lining here is that Keppel DC also has a low cost of debt of about 1.5%. So this still leaves room for accretive acquisitions. Now on to the outlook. Okay, so there have been market rumors that the Singapore moratorium on data centers may be lifted this year. So if this happens, supply could increase over the next 2 to 4 years. However, also the silver lining here is that the data center tenants tend to be relatively sticky in nature, and Keppel's track record as a data center and operator should help it retain its tenants. On the 28th of April, Keppel DC announced its expansion of mandate. With this expansion of mandate, it now can hold assets that are non-DC asset class in nature. So it means that it can hold even infrastructure assets as well as some of your industrial asset types. Okay, and KDC maintains that they will keep at least 90% of assets in data centers. So concurrent with this announcement of expansion of mandate, they also announced that they have signed a non-binding MOU with M1 to invest 87 million in the debt securities and preference shares of an M1 established SPV. So the SPV is valued at $580 million, and it will hold M1's network assets. So not much info has been released. We'll wait for the actual MOU to be inked before we can have more information. Okay, we upgrade our call from accumulate to buy on resilient data center demand as well as new data center pipeline. Our target price of $3.20 is unchanged. Recall that our target price actually includes 500 million worth of acquisitions for 4Q 2021 at an NPIU of 6% and LTV of 30%. So this is an assumption that we have incorporated into our valuation. Of course, we know that Guangdong data center comes 1 quarter earlier at an NPIU that is above our forecasted NPIU, although at a smaller quantum. But overall, as our forecast is for the full year, we will leave our target price unchanged. So just if you look at the graph on the right hand side, we see that this is the Keppel DC historical yield spread over the 10-year bond. And currently where we are, the blue line is slightly above the red line, meaning to say that the dividend yield spread at 221 basis points is close to its 5-year average of 186 basis points. Yeah. And this is of course attractive when we compare it to FY19 as well as FY20 DPU yield spreads, which were closer to the 100 basis points region. Okay, that's all for Keppel DC REIT. Now move on to Ascott Residence Trust. So this is Ascott's first half 21 results. Just starting off with the table on the left-hand side, quite a lot of details here. I'll explain them slowly. First of all, gross revenue fell by 11% and gross profit fell by 7%. And this was actually due to, first of all, absence of income from divested assets. So Ascott divested 6 assets from 2020 to 2021. So this absence of income actually reduced the top line revenue by $13 million. There was also a change in rental structure that affected the revenue. So last year, some of the master leases and MCMGI's management contract with minimum guaranteed income, these were sort of restructured to allow for either a lower base rent and a higher percentage of gross turnover, or simply they were shifted from a fully fixed structure to a fixed and variable structure. So of course this resulted in lower revenue because of course the GTO portion is not at its full potential because we're still in recovery. And not to mention, in the first half of 2020, the months of January, we had a normal trading month, and of course there was only a partial impact for the month of February. So that means that all in, the first half of 2020 was a better half compared to this year, the first half of this year, where we know the full 6 months were sort of impaired by COVID and we were still in the process of recovery. All in, this lowered revenue, but also this was partially offset by the acquisition of Paloma West Midtown, which is the first student accommodation asset for Ascott, and this contributed $2 million in the first half of 2021. So excluding the investments and acquisitions, and on a same store basis, revenue actually dips by 7%. And for gross profit on a same store basis actually dipped by 1%. So this lower 1% compared to the 7% previously dip in revenue was due to cost savings. And Ascott was able to reap some cost savings from digitalization of its operations, where it reduced the amount of man hours needed, which in effect reduced staff cost. So distributable income grew by 96%. This is because it includes 20 million in divestment gains, as well as 9.8 million from the termination of the sale of the 2 China assets, Citadines Suzhou as well as Citadines Wuhan. And also not to mention 9 million in realized FX gains, which arise because some of the loans were repaid upon divestment of the asset, and then translated back into Singapore currency, which actually helped them to realize some FX gains. And this was also paid out to unit holders in the first half of 2021. Okay. So on the positive side, we note that this is the 4th quarter of RevPAR recovery. So RevPAR has recovered 18% quarter-on-quarter and 75% year-on-year. And this was driven by improvement in occupancy. Occupancy climbed from 50% in the first half of 2021 to 55% in the second quarter of 2021. So of course, if you look at it, it's an increasing trend. Occupancy was 45% at the end of 2020 and then increased to 50% and now 55%. The gradual recovery can also be seen in the reopening of more assets. So last year, 12 assets were closed in first quarter, and sorry, in the first half, and in May and June, Ascott opened 8 assets and then 2 more in July. So this was because of higher demand. So currently 2 properties still remain closed, and these assets are in Japan, the WBF assets, and they're relatively small on master lease. So they continue to provide minimum rent. Okay. So the second positive would be the cost savings, which I mentioned earlier from digitalization. The third positive would be the divestment of 6 assets since 2020 for 550 million in proceeds and 225 million in net gains. So this translates to an average exit yield of 2%. And over the last 5 years, Ascott has divested well, achieving 63% above book value, as well as divestments, as well as 43% excluding transaction costs. Okay, and this year alone, it has reinvested 285 million in 5 long-stay asset classes, which are your student accommodation assets, as well as the rental housing assets, and at an average EBITDA yield of 5%. So they exited at 2% and they managed to reinvest at 5%. And all in so far, on a full year basis, these acquisitions will contribute about 9 million in EBITDA. And this will replace about 78% of the divested EBITDA for 2020 and 2021. Okay, now moving on to the negatives on the next slide. Ascott booked 5.3 million in provisions for Park Hotel. So they are in the process of repossessing Park Hotel Clarke Quay after its master lessee failed to make rent payments. Okay. So this 5.3 million is actually after netting off the security deposit. Yeah. So Ascott is actually trying to repossess this asset, and this asset remains cash flow positive. It is currently being block booked by the government. And of course, they will be working with liquidators to recover this debt. In terms of outlook, rising vaccination rates expected to pave the way for reopening of travel routes. Also, Ascott maintains a flexible booking and cancellation policy to give customers the confidence to make bookings. They noted a pickup in forward bookings as well, driven by corporate and leisure customers. And it aims to increase its exposure to long-stay asset classes from 9% presently to 15 to 20% of portfolio valuation. So these long-stay assets are the student accommodation assets as well as the rental housing assets, where the average length of stay is more than 1 year, about 1 to 2 years, and these assets have actually maintained very high occupancies, more than 95% through the year, even during this COVID period. Okay, so we maintain our accumulate call on Ascott. We raised our target price slightly from $1.17 to $1.19 to reflect the recent acquisitions. So FY21-22 DPUs were raised by 0.7 and 1.2% respectively to incorporate the acquisition of the 2 Sapporo rental housing assets in June, as well as FY23-24 DPUs raised by 1.8% and 2.3% to account for the 45% stake in the student accommodation development asset. Okay. So moving on to CapitaLand Integrated Commercial Trust. Okay, so CICT also announced its first half 2021 results. So we look at the table, we see that gross revenue grew by 102.8%. And also, of course, that flows down to DPU increasing by 75%. So this 102.8% increase in gross revenue was due to the lower base effect from so in first half of 2020, that was before the merger between CMT and CCT took place. So 1H20 numbers were purely just CMT's retail portfolio. And then, of course, now where we are in the first half of 2021, post-merger, which was completed on October 2020. Yeah, so this figure includes both the CMT and CCT office and retail portfolio. Okay, and that also with the merger completed, Raffles City Shopping Centre and the office tower have now been consolidated on the top line. So previously it was recognized as a JV, so that also helped to bump gross revenue. Okay, in the net property income line, for the first half of 2021, CICT gave 18.9 million in rental waivers, and this was lower compared to in the first half of 2020, where 76.5 million in rental rebates were dished out. Okay, so distributable income also increased. This is because in FY20, DI was lower due to 46.4 million in that was retained in view of challenging operating environment due to COVID-19. So there was no amount that was retained for this first half. So on the positive side, we see that the first half tenant sales grew by 5.3% year on year and is currently now at 86.3% of 2019 levels. So suburban malls did better than downtown malls, and tenant sales were 94.1% versus the downtown tenant sales, which was 75.7%. The biggest rebounds in terms of trade category came from the jewelry and watch, home furnishing, and education. And these trade sectors were up by 46, 27, as well as 25% year on year in the first half of 2021. CapitaLand's digitalization effort has also paid off. Gross merchandise value (GMV) generated on eCapital Mall as well as Capital Treats, which are the online store as well as the food ordering platform, grew by 2.5 times and 2.8 times year on year during this phase 2 heightened alert period. So while there was a ban on dine-in, these two initiatives or these two platforms were able to capture some of the sales. Yeah. Okay. Another positive would be that the malls were kept occupied and cash flowing. Occupancy remained high for the retail portfolio at 97%. Okay. Yeah, and of course, this was also aided by CICT's holistic approach to provide tenant support. So some of these measures include restructuring leases on lower base as well as higher turnover rent to help share in tenants' weaker trading, and of course establishing online platforms to provide them with an omni-channel outreach, marketing and promotional efforts to spur sales as well as rental rebates. So this restructuring of leases actually helps CICT align itself with its tenants and of course allowing rents to vary with how well the tenants trade. And this helps to accelerate leasing decisions by tenants who are concerned with the fluid leasing situation. So in terms of new openings for the second quarter of 2021, F&B and fashion accounted for 44.7% and 27% of new openings. On to the negatives. The negatives are primarily related to the office portfolio. So we saw that occupancy dipped by 2.4 percentage points quarter on quarter to 92.4%, with significant backfilling required across the portfolio. And the second quarter leasings were hampered by the phase 2 heightened alert period, but were still up by 1.1 times quarter on quarter. Okay, so there's significant backfilling required due to relocations and downsizing by the banking tenants. This includes space vacated by Standard Chartered at 6 Battery Road, Allianz at Asia Square Tower 2, and Capital Tower by JP Morgan, which is relocating to Capital Spring in the fourth quarter of 2021. There was also an early termination that was exercised at Galileo. So Commerce Bank, which occupies 98% of Galileo, has exercised its option to pre-terminate its lease to consolidate its operations. And of course, this will bring forward lease expiry from 2029 to 2024. And CICT has engaged a property consultant to assess its options for marketing as well as the leasing of space. Moving on to the outlook. For the office, we saw that office market rents actually stabilized in the second quarter, inching up quarter on quarter from $10.40 to $10.50. Full year reversions are likely to end in the red. If you look forward, we think that FY22 reversions should be positive, while FY23 reversions, could end up in negative again. So of course, FY22 reversions being positive is likely because the passing rents for FY22 are lower at $9.19, and of course higher at $11.03 for FY23. Retail reversions were negative for the first half of 2021 at negative 9.1% on an incoming versus outgoing basis. Yeah. But recall that a lot of leases were actually restructured so as to help tenants lower their occupancy cost by lowering the base rent, and then of course increasing the variable gross turnover rents. Yeah, so if we were to compare reversions or measure reversions on an average incoming versus average outgoing basis, meaning the average of the first 3 year the outgoing rents versus the incoming rents, which will include the step ups in year 2 and year 3. So on an average to average basis, the reversions were less negative at negative 4.5%. So based on CICT's sensitivity analysis, tenant sales growth to 120% of pre-pandemic levels should bring gross rents back to pre-COVID levels. Overall, we maintain or accumulate an unchanged target price of $2.54. FY21 DPU dips by 8.3% after factoring in 1 month of rental rebate for retail tenants. Okay, so 0.3 months for first half of 2021 and 0.7 months for the second half of 2021. So the current price implies a 4.7% DPU yield for FY21, and sustained economic reopening as well as return of tourists could help spur sales closer to pre-pandemic levels. That's all for me. I'll now pass the time on to Jie Hui for Keppel REIT.
Thanks, Ned. Next, we have a video on the ground on Keppel REIT. They announced their first half results just last week. So just a note, we do not cover the counter. Generally, first half results were positive. Distributable income and DPU was up by 11% and 5% year on year. This was mainly due to contributions from Victoria Police Centre, Pinnacle Office Park, as well as Keppel Bay Tower. Higher one-off income from ORQ as well as MBFC were also recorded. KREIT's income stream continues to be resilient with high rental collection and minimal deferrals. Occupancy remains high at 97%. In terms of leasing activity, KREIT saw more renewals. New leases mainly come from your usual suspects like financial institutions, manufacturing and distribution, as well as tech, media and telecoms. Expiries remaining in FY21 are minimal at 6% by NLA. Singapore's offices still remain the main anchor to KREIT's income stream. In terms of outlook, Singapore office saw a slowdown in leasing momentum, especially in light of the recent Phase 2 heightened alert. This may only improve from 4Q onwards when the government allows for more people to return to office. That said, full year reversions are still likely to be positive. This is given that expiring rents are currently still below that of passing rents. Grade A office supply coming on stream is also limited, so this will actually help support rentals in the near term. Last point on the outlook for Australian portfolio. For the different CBDs that KREIT has presence in, Sydney, Macquarie Park and Brisbane are seeing lower rents and occupancy, while Perth and Melbourne are seeing a slight improvement. Moving forward, we are expecting near-term pressures on both occupancy and rents for the Australian portfolio. This will be due to the weaker leasing environment in the market. So this is all for Keppel REIT. I'll move on to Phillip on the ground on Far East Hospitality Trust. Again, we don't have any coverage on the counter. So in their recent update, first half 21 saw lower MPI but higher distributable income and DPU. MPI was lower due to rent rebates and weaker demand for commercial premises. Distributable income after retention was higher, mainly due to lower finance expenses and REIT manager fees. So now breaking down into segments, hotel continued to view from lower average daily rate due to MCO and isolation businesses. Currently, 7 out of 10 of their hotels are on government contracts, and these contracts are valid till the mid of August. So just combining both outlook together with the results, these contracts are the government has actually provided a verbal agreement to extend these contracts by 2 months for the purpose of SHN's quarantines and isolation. There's even a new category called community care to host locals that are infected rather than hospitals. So even though there is a pre-termination clause for the government to halt the isolation business earlier, we think that it's unlikely that the government will exercise it given the flexibility of the hotels to take on various degrees of COVID risk profiles. So at the very least, till the mid of October, income stream from these government booked hotels should be relatively stable. Now, service residences saw lower revenue per average unit due to weaker corporate demand. This is a result of lower occupancy and rates recorded for the half year. Corporate demand is coming from long-term travelers that are relocating due to their job postings, various project and infrastructure works. But this is still lower than pre-pandemic, given that independent corporate travelers that are here for meetings actually dropped substantially. That said, service residences are still performing over fixed rent and break-even levels of $130. In terms of the longer-term outlook for both the hotels and the service residences, the recovery will largely still be hinged on the major lifting of travel restrictions, the success of vaccination programs, as well as the widespread use of vaccination passports and certificates. Muted average supply for the new rooms over the next 4 years should help to support rates. For the last segment, the commercial segment, as mentioned, may still remain weak, especially for the retail segments of the hotel portfolio. Far East Hospitality Trust provided assistance through half a month of rent rebates, as well as the changing of rent formulas from fixed rent to percentage of GTO, as well as the waiving of interest and rental for some of the suffering tenants. In particular, there are travel agencies in hotels, as well as family KTVs like Teo Heng in Rendezvous Hotel. So this actually contributed to the 23% drop in top line, and in top line for that segment. And as phase 2 heightened alert is extended, these retail tenants may continue to suffer from the lack of patrons. So Far East Hospitality Trust may continue to provide some rebates in second half for these tenants. This is all for the video on the ground. I'll pass my time on to Vivian for Lippo Malls.
Thanks, Jie Hui. So I'll be covering a Phillip on the ground for Lippo Malls Indonesia Retail Trust, or LMIR for short, their second Q results update. So firstly, a quick overview. The portfolio consists of 22 retail malls and 7 retail spaces within other retail malls, all in Indonesia, with a total net lettable area of about 958,000 square meters. Moving on to the key highlights. First of all, the 2Q21 figures were up. So gross revenue was up 81% year on year. MPI and distributable income both more than doubled that of 2Q 2020 levels. So a few reasons for this. First of all, 2Q20 was a lower base due to the fact that the mall operations were impacted due to the lockdown then. So the malls were closed from the end of March and gradually opened from June. So it was only about a month of rental income. Other than that, they also had a full quarter's contribution from acquisition of Puri Mall in January and lower rental and service charge discounts. Due to the rights issue that they did for financing the acquisition of Puri Mall, DPU was down about 18% to 9 Singapore cents, even though distributable income was twice that of 2Q20 levels. As you can see from the graph on your right, if you refer to the yellow line, the overall visitor traffic has recovered to more than half, about 56% of pre-COVID levels for the reporting quarter. They have a debt of 77.5 million Sing dollars due to expire in 2022, and the portfolio average occupancy rate slightly dropped to 83.4% from 88.2% in 2Q20. And 25.4% of expired or due to expire leases have renewed or committed to renew their leases. So the management also shared that they are open to signing shorter leases. And an example would be this anchor tenant in Istana Plaza, which is not renewing their lease after expiry. So they are looking for smaller tenants to fill the bigger space. More recent updates include the new lockdown. So the Indonesian government imposed this new emergency public activity restrictions affecting the malls in Java, Bali, and Medan from 3rd of July to 2nd of August. So it's until today. And as such, they are expected to continue to extend rental waivers to affected tenants at least until the beginning of 2022. And the reason for this is that there's this national target of 3 million doses of vaccines to be administered per day by October 2021, about thrice the current level of 1 million doses per day. So with that, they are expecting the COVID situation in Indonesia to more or less stabilize by the beginning of 2022. So that's all for Lemer. I'll now be moving on to Japfa Limited, which released their first half 21 results. So again, this is a Phillip on the ground, and we do not have any coverage on Japfa. So to start off with an overview, they have three main business segments. PT Japfa TBK here, which they mainly do poultry breeding and the sales of poultry. Animal protein other, or APO, mainly in Vietnam, where they do swine fattening and breeding, and also dairy in China. So looking at the results on the revenue line, first half 21 revenue was up 23.4% year on year. And on the PATMI line, PATMI was also up 54.3%, but the revenue was up due to higher sales volumes of all the segments. And if you look at PATMI for each segment, in the box highlighted in red. So for animal protein other, the APO segment, the PATMI was affected by the reduced swine fattening ASPs. So if you look at the outlook for each segment in detail, for PT Japfa TBK, the prices of broiler, which means grown chickens, and DO chicks, DOC, have been on a recovery trend since 4Q20 when the government took culling initiatives. And the reason for this is that the prices fell steeply in 2Q20 when the COVID hit Indonesia then, and the demand was badly affected. So moving forward, they are also expecting that the worsening COVID situation could affect the demand negatively again. For the APO segment, as mentioned, the ASPs for swine fattening have been coming down, but the demand has remained relatively stable, so they are ramping up the production to increase the sales revenue. Lastly, for dairy in China, they are continuing to accelerate supply expansion and increase production as China's raw milk supply remains in shortage as the demand continues to grow. So that's all for Japfa. I'll now be covering the Phillip on the ground for Aztech Global, which released their first half 21 or 2Q21 results last week. Again, we do not have coverage on Aztech. So looking at the numbers straight, 2Q21 revenue was up about 46%, and net profit was up 30% year on year to 16.2 million. First half 21 revenue almost doubled to 250 million, and net profit increased to 30 million. So if you look at the graph on your top right, the picture, you can see that the revenue contribution from IoT and Datacom products increased or more than doubled to $233 million, and the revenue increase was mainly driven by this. So it now contributes to 93.2% of the total revenue. Another interesting figure to look at would be their inventories level. So inventories increased to 92.4 million, up from 54 million in second half of FY 2020, as the company actively stocks up in the current environment of component shortage. Production in Malaysia, production orders as a whole was not affected due to the MCO 3.0, as those to be done in Malaysia were transferred to the China facilities, and they made sure that production was smooth and delivery was on time. The order book as at 30th July 2021 was about $600 million, and this is inclusive of 150 million worth of orders scheduled for completion in FY 2022. So bulk of it is scheduled for completion in FY 21. More recent updates include their Malaysia manufacturing facility resuming operations at 60% of manpower capacity, and they have completed the expansion of the production facility in Malaysia, with the area almost doubling to 86,000 square feet, up from about 45,000 square feet. So the management also shared that they are continuing their production maximization plan. And what this means is that in view of the increase in demand for IoT and datacom products, they will be allocating more resources for the production of these products to meet the demand. So that's all for me for Aztech. I will now be passing the time on to Terence for Keppel Corp.
Thanks, Vivian, and good afternoon, everyone. Keppel reported 2Q21 results. We saw the group firing on all cylinders as earnings reversed the loss from last year. In our current slide, when you look at the table on your left-hand side, you can see Keppel reversing the loss of $537 million it incurred last year, mainly due to impairments of $900 million, and registered a $300 million gain this year. The net profit of $300 million came ahead of our forecast at 70.8% of our full year 21 earnings. This was boosted by recognition of $269 million from its share of Flotel restructuring gains. Keppel Offshore and Marine turned EBITDA positive in first half 21, but still registered a narrow net loss for first half 21. Net order book grew over 70% on a year-on-year basis. Their Vision 2030 asset monetization program is also ahead of their schedule. Keppel has updated their guidance for the asset monetization program to now be at the higher end of its $3 to $5 billion guidance range by 2023. Following this results announcement, we raised our earnings forecast for financial year 21 by 46% for higher estimates for its O&M, urban development, and asset management business on the promising tailwinds. In our next slide, one negative we have on Keppel's results is M1's net profit, which was 47.5% lower on a year-on-year basis due to lower roaming and prepaid revenue as lockdowns continue to impact M1's revenues and profits. M1's net profit of $21 million was lower than its $40 million in first half 2020. We expect some form of agreement in the fourth quarter of 2021. While nothing has been firmed up, we view the discussions positively as it provides better clarity on the fate of its O&M unit. With the overhang removed, along with the planned divestment of its logistics unit, we believe Keppel will be re-rated. Earlier in the morning, Keppel also announced that it is proposing to acquire to take Singapore Press Holdings private through a $2.2 billion privatization offer after SPH media business has been hived off. The offer will value SPH at $3.4 billion and will see SPH become a wholly owned subsidiary of Keppel. Under the offer, SPH shareholders will receive 66 cents 8 in cash per share, as well as 0.596 Keppel REIT units and 0.782 SPH REIT units per share. We will elaborate more on the deal at the Q&A section. I think we will consolidate some of these questions later and then we will answer them. In our last slide on the recommendation of Keppel, we maintain our buy recommendation on Keppel and raise our target price to $6.28 from $6.20 previously. We ascribe a higher multiple to its O&M division on the back of an improving sector outlook. We now value the O&M division at 0.8 times book versus 0.7 times book previously. We also apply a 10% holding co discount on the group's different business units. That's all from me. I'll now hand over the time to Paul, who will cover Raffles Medical.
Okay, thanks. Thanks, Sharon. I'll run through Raffles Medical first half results. The title "Navigating the Pandemic" is because they actually managed to gain some new revenue streams because of the pandemic. Next slide. Okay, if you look at the revenue jumped very strongly, about 42%. It's across healthcare, which is the GP clinics and hospitals. So the positive was that the strength in the revenue, and I think the two reasons is the COVID-related vaccination and also the PCR swab test. So there are some of the two big growth drivers. And this was helpful because Raffles Medical relies on foreign tourists, medical tourists, and with the border lockdowns, I think they got hit initially, but I think with the government filling up with this COVID-related services, this helped boost revenues. In terms of cash flows, just a reminder that with the jump in revenues, the cash flows also performed very well. The negative was dividends. There was no interim dividend paid this financial year. They will be paying a final dividend, and they mentioned that the expected final dividend will not be less than 2.5 cents. Our estimate is about 3 cents. So overall, the results was within our the results actually beat our expectations. We did not expect the revenue from COVID-related services to be so high. So as a result, we had to raise our estimates. In terms of the outlook, the second half will still be strong. If you just do some ballpark number in terms of how much more vaccination needs to be done, roughly, if you assume 80% vaccination target or 9 million doses, the country probably hit in end June about 60%. So on paper, there's at least another 40% of vaccination to be done. So they can replicate the kind of vaccination business to be done in the first half, and also the PCR business in the second half too. So second half should still be strong. But curiously, of course, we actually downgraded it, and the main reason is the 2022 is our worry. I think once you move into 2022, you won't get this vaccination business will disappear. Hopefully, there will be some booster shots they mentioned, but the booster shots, the scale won't be like what is seen in vaccination, because you have to accelerate. I think if we do get a booster shot, it will be done at clinics and it will be spread out and won't be so concentrated, all done by the hospital chains. So what we're worried is just that as we go into 2022, the transitioning, you will lose quite a bit of this vaccination business. Then as you transition into, you have to rely back on your foreign medical, which is where the border reopening is still unclear. So that's why we have a neutral. We're still not sure 2022 how the numbers will look like. There's very little visibility. So that's why we have a neutral. Although the first half numbers, because this COVID-related services in a way is almost like a one-off, hopefully. Next slide. For Sheng Siong, reported their second quarter results. It were record margins. That was the key highlight. Next slide. Okay, we have a accumulate maintain. I know Maybank initiated with a sell call. I think they also initiated a sell call 2 years ago. So maybe this time around they could get. Maybe this time around could be more accurate. Their last sell call was 95 cents in 2019. Anyway. Okay, let's go to the results. The positive for us, for Sheng Siong, was the gross margins was a record high. It was a surprise because in second quarter 2020, which is last year during the circuit breaker, we thought margins would have been high because it was 28%, but now it's even higher than during the pantry loading when everybody, when there was a panic buying and pantry loading by everyone. So the reason why the margins expanded was a combination of fresh food, and also surprisingly, also their house brands is also doing well. We'll elaborate a bit more later. The negative is there is no new stores. So this is one negative for us. Because in Singapore, supermarket sales, once it's stabilized, how fast can it grow? Only 2-3%. So a lot of the growth in the past for Sheng Siong was in new stores. So you're not going to get any new stores this year. They submitted bids, but even if they get any store, will be year end, and it take some time to fit. So virtually no revenue from new stores for this year. So the results actually beat our expectations in terms of profit. In terms of the outlook, the revenue is still elevated at 2,003 compared to the pre-pandemic 1,009 per square foot. And we think second half will still be healthy because we all have dining restrictions and the borders are so close, are still closed. So there's more dining at home, and also there's basically more households stuck in Singapore. So as a result, the grocery spending by default will be higher. I won't run through other things. The other thing is their e-commerce. This is just a side note, just out of interest, if anyone wants to understand. So a lot of questions by us on the e-commerce. So the thing is that they are building up their capability, but the bottleneck for e-commerce is the delivery and fulfillment, because you need to do, the delivery, you need to build scale on that. And the other thing is that they are break even, but they find it challenging to turn e-commerce very profitable. Because the problem is the high margin business, the products that has the highest margin, nobody buys online. So all the fresh food, people seldom buy online, and that's the best margin. Instead, households like to buy the toilet paper, beer, and those are bulkier, heavier to handle, low margin, and a lot of high handling fee. So it's the opposite. So e-commerce, in the end, households buy e-commerce for the lower margin and very costly to handle items. So in the end, e-commerce is something that they are still pursue, but they are a bit cautious not to push everything through e-commerce because the profitability there. So we maintain accumulate with lower target price. We put it 169 and we are benchmarking it to 2022 because we are trying to benchmark to normalize earnings. So FY21 will still be very strong numbers compared to their historical norm. Okay, next slide. Just a quick one on the weekly update. So just some updates on some of the macro news that came out from Singapore. In terms of, if you want to know what's going on in the hospitals, actually year-on-year hospitals RevPAR basically is almost like sales for a hotel because it's room rates times the price of the room. So if you do year-on-year, actually the RevPAR for hotels in Singapore is almost double, but comparing with pandemic. But if you compare to the pre-pandemic, it is still like way down. I mean, before pandemic, the average RevPAR in Singapore hotels was about 180. Right now, it's only 75. There were some good numbers from the banking sector. I think the loans growth has started to perk up. So loans growth is up 3.5. This is the strongest in 24. I mean, more than 2 years. The loans growth. So it's a good, and hopefully the momentum can continue, and this could be another driver to the bank share price. I think we all heard of the news on employment. A bit surprised that all sectors the employment is down. The other thing from the US was the FOMC meeting. So Powell, I think he's still very hesitant. I think the key comments he made was he was focusing on labor market. In terms of the question, when will he raise rates? I think the answers was all about jobs. So he wants to see stronger job numbers before he actually move interest rates. And the high inflation that you see right now for him, at least from what he says, is that it's all due to temporary things like used cars and so forth. So the key thing to watch is, in the US right now, the unemployment supplementary benefit. That means if you're unemployed, apart from the, I think, 1,000 plus that you get another 300 every week. So maybe that's the reason why people don't look for jobs right now. But all this ends in September. So it'll be interesting to see the October, November employment numbers to see whether without the employment benefits, whether you get this big surge in labor, and that could be the timing where the Fed could move a bit, or at least kind of mention that they will taper. In our view, we still positive on the market. We think strong results will drive the sentiment and momentum. Yeah. I won't run through all this, but these are some of the events. I think 1 or 2 days time, Wednesday, we will have HLH, if those are interested. And the following week, we'll have quite a number of webinars for those who are interested to attend. Next slide. Okay, very quickly, the blue line, we're getting this big bounce again in the number of cases globally. I won't run through this. Next slide. Again, this is the red one is the Indonesia. That's the worrying thing. So hopefully they can get their vaccinations up. And the one in green is the other one to worry about because this hurts Thai beverage. So you can see that I think Thailand just announced they're going to prolong their so-called, they're going to, their lockdown measures is going to be lengthened and more provinces are going to be locked down because as you can see from the green line, Thailand, the cases continue to surge. Okay, next slide. Okay, in Singapore, just some stats for everyone. The cases actually come down a bit, but it's still very high. I think the average case now we have is 126. Circuit breaker was 56. So it is more than double what we're having in circuit breaker. The good news, I guess, out of all this is that the first dosage in Singapore is 77. So this means that we could get the full vaccination, because 77 usually those who get first dose should get the second. So we could be on track to hit that so-called 80 or inverted comma herd immunity by 1 or 2 months, hopefully. So that's a good thing. I mean, our vaccination is strong, vaccination rate. Yeah. Next slide. This is just for everyone's update. This is just illustration of the numbers. I won't run through, but for the banks, you can see there's a bounce at least for loans, and it's not only just consumer loans, which is property loans. You also see it in business loans. So this is a positive development for the banking sector. Next slide. Okay, as usual, we'll go through month end. We will go through our model portfolio. So the performance for model portfolio is 2.4. I mean, this is for illustration. What has done well for us has been the yield. The yield stocks last month did well. I think you can see Asia Pay TV, Ascenders. What has dragged down is Thai Beverage and also ComfortDelGro. I think the lockdown has affected, all these are impacted by COVID. Thai Beverage is down and also Comfort is down. The table on the right is just an illustration of how we've been performing, just an illustration. And hopefully we can claw back after the Yoma losses. Next slide. Okay, this is just to, I know there's a lot of names here, but I'll just run through. This is the July performance of the market. So what did well in July was the REITs did well, the industrial REITs. So and what didn't do well was the conglomerate. So if you look at the one in the middle, the top 10 gainers last month, actually a lot of the coal stocks did well. Golden Energy, Gear was up almost 33%. Propnex again bounced back up 25. Raffles Medical, and again Apex and Geo is another coal company. So the coal companies did very well. What was weak was Dairy Farm did very badly. I think their results was down 70%. Banyan Tree too. This is just for everyone's reference. I won't go through too much in detail with this. Next slide. Okay, anyway, just for coal, we were just curious, like what's happening in coal, because Geo and Golden Energy did well. So you can see the coal prices has just spiked up recently. A couple of reasons. You can see on the right, the demand for power in China is bounced back very strongly. And you know, in Singapore, power demand is only 1%. So if you look at the chart on the right, we're only at the bottom, but China's power demand is very robust. It's almost 4 to 8%. The last couple of months. So that is the one driver. And of course, China is not taking much coal from Australia. So that's why the demand for Indonesian coal is surging. I mean, just for everyone's reference. Next slide. This thermal coal. Okay, in view of time for the first REIT, we went for Phillip on the ground. So the first REIT, they actually own a lot of hospitals in Indonesia. There's a bit of restructuring here. In the past, first REIT used to collect rental income from Lippo in Sing dollar terms. But now this has changed, and the interesting thing for me is that they will get the higher base rent. Every year they'll get an escalation of the rent in 4.5 or the higher of 8%, which is the revenue of the hospitals. So in October, you're going to see, which is a curious thing, in October, the rental income will just automatically jump 4.5% because that's when they will have to do the computation. I won't go through this too much unless you want to ask questions, but post-restructuring, the whole thing has changed. You get direct exposure to Indonesian rupiah, and also you get reduced exposure. You're de-risking because you won't have exposure to Lippo, Karawaci, which had a bit of balance sheet issues. And your new sponsor is OUE. And also the final point, the hospitals in Indonesia are doing very well. So the Siloam Hospital, the largest private hospital in Indonesia, the revenue is up 51%. Partly because of the pandemic and so on, but and so they could get some exposure to this because they are getting paid 8% of the revenue of 14 hospitals, not the whole 40. This just for reference. Unless you have questions, I only go through detail. Next slide. Okay, this is our final slide. So in terms of results coming out this week, a lot of banks, UOB, OCBCs, SGX, DBS, Venture. So a lot of names are coming out this week. This is for your reference. I think should be Wednesday, Thursday. Most of the banks should be out by then. So hopefully they can give some positive sentiment to the market. Okay, I won't go through too much because of time constraints. Next slide. Okay, that's it. I think we can have questions if there are any. I think let's go through the main one. I think everyone's asking about the Keppel Corp. I think that's the obvious one.
Yeah, thanks, Paul. So I'll just go to the top rated question here. And then there are a few, so I'll just combine the questions. The first question is, please comment on Keppel Corp proposed acquisition of SPH. And then the second question is, Keppel offered to take SPH private after restructuring of media businesses. Please advise. So we'll make a few points. The acquisition of SPH is part of Keppel's Vision 2030 plans. The second thing is, this acquisition of SPH there are actually inherent synergies in the acquisition of SPH with Keppel's existing portfolio, namely their urban development business, the connectivity business, and the asset management business. So this acquisition complements the existing Keppel's portfolio. The transaction will also be in the near term. So when we look at this, we try to look at it from the near and medium and long term perspective. In the near term, the transaction will be earnings accretive to Keppel shareholders because it is EPS accretive, and it will also build its recurring income from 51% to 56% post-acquisition. So Keppel shareholders will immediately see the accrual of the positive transaction immediately after the proposed transaction. In a medium to longer term, we think what is more important for us is how Keppel can monetize the SPH portfolio, and that will be very important for Keppel in lowering their net gearing and also in terms of realizing value from the acquisition of SPH. So there is no certainty yet in terms of whether they will be able to do this, but we think Keppel's track record of being able to monetize assets, especially because in the just last year to this year alone, they already announced $2.3 billion of asset monetization already. So we think their aggressive asset monetization track record gives us some confidence in terms of Keppel's ability to monetize SPH portfolio, which will then create value for Keppel shareholders. Yeah, so let me know if I missed out any part or if you wish to clarify anything. That's all the thing on Keppel. I'll hand over to the rest of my colleagues.
Yeah, okay. Let me just add on because Terence is on the Keppel Corp, but let me just share with you what I think from the SPH point of view. From SPH point of view, the offer price looks low. The offer price, just to recap, so if you're an SPH shareholder now, the offer is $2.10, roughly $2.099, and 1/3 comes in cash, 1/3 comes in Keppel REIT shares, 1/3 comes in SPH REIT. Right? So if you're a SPH shareholder, if you take this offer, you're going to get cash at Keppel REIT and SPH REIT at $2.10 roughly. But the book value of SPH is about $2.08. So you're actually buying me out at a book value, but there's a lot of value in SPH book. The PBSA, even Keppel themselves mentioned the PBSA is 90%, the occupancy is high, and they're very excited about the business. Then there's also monetization of all the e-commerce assets, the good class bungalows. And so that's number two about the valuation is only at book. And number two, you're giving me SPH REIT shares and Keppel REIT shares, which can actually drop from the price that you kind of benchmark, right? Because they are pegging the price at 30th July. Because a lot of SPH REIT shareholders, SPH minority shareholders, when they get the SPH REIT and Keppel REIT shares, they might just sell it. Because that's why they want to monetize, right? And they never intended to own a Keppel REIT office REIT shares. And also, if I'm a holder of Keppel REIT, and you are worried that a lot of 20+% block of shares are going to end up in a lot of minority shareholders who are going to be very loosely held. You also worry there'll be a bit of sell down. So there's a bit of worry that Keppel REIT also could get sold down. And then you may not even get the $2.10 value. So there's a lot of risk in the deal. If you give me all cash, it's fine. I mean, not so bad. But you're giving me in shares, there's only downside to it. And whatever synergy Keppel mentioned is for Keppel shareholders. It's nothing to do with SPH REIT shareholders. I just sold it. I'm not going to get any of this so-called synergy that has been mentioned by Keppel. So I just found that the valuation is good for Keppel, like Terence mentioned, but for SPH shareholders, I think the price is a bit low. That's my own point of view. Yeah, okay, let's move on to the next thing. anyway, the question is, SPH REIT shareholder, is it better to sell them before the deal is done? Okay, on paper, you worry because if this deal gets done, there'll be one whole block of SPH REIT shares now in SPH minority shareholders. But on the flip side, you might get, I'm not sure if they're on the index or they're on the, I don't think they're NAREIT, but whatever index they're on, they could, because the float is higher, you could get some flows into it, but I really no idea. I think I also asked this, they couldn't reply, like how much flows in it. So there is a risk that there'll be a bit of overhang on the Keppel REIT and SPH REIT shares. Yeah, because there's so many new shares being kind of farmed, given out in the hands of minority shareholders. Thanks.
Maybe I'll go the next one. So there is a lot of question today, so I'm just going to do one by one. On the technical side of questions, so these are the one that I screened earlier on. I think most of the popular counters that is being asked. Okay, so go through all the list here, and then after that just done and then pass back to my colleague, especially Natalie, on the REIT sector. Okay, so without further ado, I think first question, I think BABA was quite hot, all the Hong Kong tech stocks, including the Hang Seng Tech Index. Okay, so BABA, so you can look at BABA, right? I've been sharing this across both the US webinar and the local webinar. That the potential rebound is actually on the large support zone between 184 and 198.2, and since then it has fulfilled. But with the recent tech sell down and the recent what you call it, the crackdown, I'm not very sure that it did rebound, okay, but I'm not very sure that will it break the falling wedge or not. And then 222 to 228 gap resistance zone need to be broken to actually to pass on to the upside, all right, to target $300. All right, so look out for this. All right, momentum seems strong after a gap up, filled up, and then let's see how this candle going to end today. This is like currently a high wave candle. So if it closed exactly like high wave candle, then it's not really going to be a very, very good news. Okay, so next one is Ping An. Ping An technically, if you look at a larger chart, right, it has broken the larger rising wedge, a smaller diamond top. So any pullback will be just a breakup to retest the rising wedge and then continue to sell down again. All right, so that's the larger what do you call it, a larger time frame analysis. But you can look here, yes, it did rebound from the support zone too. However, I think this resistance, this support term resistance at 78 to 79.85 remain crucial. All right. Also, we do need to consider the fact that 74 to 76 immediate resistance zone need to be broken. All right. So, but we can safely assure that that there is an immediate upside to 74.05 in the next few couple of days. Should there be no problem. All right, Tencent is another one. Bullish hammer confirmed overbought with a high strong volume last Friday, last Thursday, if I'm not wrong. Okay, so but after it gap down, it gap up, it seems to have a retracement. So right now we are maybe in some sort of like a mixed trend. So we are going to see this major support term resistance zone at 517 to 539.2 being tested. If this rejected, then there will be a renewed selling all the way to 362 or $400 region. But let's hope that it won't do that. All right. Next one is China Soft International. Someone asked about this, and I think there is a good chance that I share about this on the Hong Kong side of business. I think I shared this during on the Telegram. I don't know if you are the one asking. Okay, so successful rebound from the support zone 1. Okay, so it cleared the immediate resistance zone at 14.16. If it maintained by end of the day, we are going to see $16 as the new target. Okay, so that is the one that we are going to see over the midterm to short-term period. All right, so $16 is the target. All right, so next one is Hong Kong Exchange. Hong Kong Exchange hit based on my report from the last time during the inverted head and shoulder, that was in April. Price successfully moved up, but rejected, came down with an evening star. All right, but it rebounded rebounded above the 63 period exponential moving average. So currently, I think that we are going to see a retest of the resistance zone at 543.6 to 566.80 cents. All right, this is the one that I'll be looking at. All right, I know SDI is not part of the question, but just saw some interesting thing which we should share on the SDI index. So first of all, the panel is developing, but there's a resistance zone. All right, that's been tested multiple times. So, but the hammer, all right, wasn't like this shooting star. All right, isn't really a good news. So if we close it, so we might be seeing a correction down to the support zone at around 2971 to 3023 before a rebound to break on the upside. Nonetheless, I think if you look at here, the STI is still on the bullish upside. All right, let me see, is this the correct one? So, oh, sorry. Yep, this is the correct one. All right, so this is the one. I think there will be a slight correction, rebound to the upside. All right, okay. Okay, next one, Venture. Venture double bottom since has not been broken, but the multiple testing of the immediate resistance zone seems to be like on the way. So, but this candle may be an bearish shifting star, especially is below the tight consolidation of the 263 exponential moving average. So therefore, if this is confirmed, all right, then we will be seeing some sort of like slight correction, perhaps to the $18 region. All right, before rebound to the upside to test the upper side resistance zone at $20.72 to 21.14. Okay, but if you look at the weekly chart, we are still right now trending within a range, very strong range actually, to be honest. Okay. All right, Dasin, someone asked about Dasin. True to be told, Dasin is still on the downtrend. Despite this very strong bullish candle, it did not sustain, and then there's some sort of like inside consolidation over here. This candle do mirror this one. So if this happens, then we can see that Dasin is going to range form maybe a bearish panel going forward. Okay, so right now Dasin is kind of like a ranging type of momentum within the downtrend, and if the panel is formed with weak momentum, then we can say we can safely assure that Dasin is still resuming its downtrend going forward. All right. Okay, SMIC descending triangle break on the upside after the bullish engulfing candle on 27th July. Was formed, and then it breaks on the upside, but right now $38.30 is being tested, so hence we are not very sure on what is it, but we are sure that 31.15 to 33.15 is the ultimate resistance zone that will be tested ultimately. Okay, so next one is CNOOC, divergence rising wedge, dark cloud cover based on 1 month ago, it formed a downtrend. Right now, there's some sort of like a support bottom right here at $7.63 to $7.67. All right, this candle, there's a bullish candle on the upside. So, but I guess the momentum will likely to be kept at $8.50 maximum before going down to test a larger support zone at $6.24 to $6.67 going forward. All right, Xiaomi, without further ado, Xiaomi issued a report on the upside break of the ascending triangle, but it failed without targeting the resistance zone. Right now, there's some sort of like a minor rebound. So hence, this consolidation is not yet confirmed. But I think that $28 may be a strong resistance before it goes down and sell. So hence, looking at a new support over here at 20.50 to 21.95 going forward. Okay, Nanofilm. Nanofilm is one of my stock pick, and then one of the rules of 40 stocks. If I remember correctly, upside has been going very strong. We have completed sub wave 3 of the ongoing wave 3 of the Elliott wave count. So this is the primary wave. So 1, 2, and then we are ongoing on the wave 3. So it has achieved my target price 1. Okay, right now we may be on wave 4. Price maybe came down, correct slightly at $6.05 before rebound to the upside to achieve my target price too. For more information, you can go to stocksdnb.com to read more about my report on Nanofilm. I'm quite strong bullish. Okay, iFast. Also I issued a report saying a few days after there's an upside, but it failed to hit my target price at $10. First target price actually. So the correction right now, all right, there's a gap up. So this look like a morning star. So if above the 63-day moving average, if this breaks above $8.71, then and then subsequently $9.23, then we can safely say that iFast is back on the bull run. So what's the trajectory that I'm looking at is maybe this, and then goes up higher on the upside once again. My stop loss level should be around here, if I remember correctly. All right, ISDN, strong bullish upside, ongoing wave 3 of the intermediate phase. You can look at Canon, it's already broken. Successive upside, bullish flag, hammer above 63 MA period, break above the immediate resistance level already. So it's sustained across. We can see that the next level at 82 cents will likely to be broken once again, and then we'll target next one at around the wave 5 at 6.945 to maybe $1 that we are looking at. Okay, so this is one of the upside for ISDN. SunPower Group, SunPower fake bull trap, and then subsequently, I think we are right now into a bearish downtrend. Okay, so if we change this to a 50, and then you can see that we are inching closer to death cross actually. So yes, price has really been trending down. So once it crossed below, we can see likely a further downside will be happening for SunPower. Look at the weekly chart. I think we are looking at further downside. Preferably, if this support zone is going to break, then we're going to look at 46 cents to 50 cents for upside rebound in the long run. Yangzijiang ranging support and resistance zone seems to be weakening. So hence, I'm looking for, instead of Canon, I may be looking for a flat, and then prices may come down here to 1.22 before rebound. Let's see how it's going to perform. All right, lastly will be Sheng Siong. I believe that this immediate support zone at 1.48 to 1.51. There's a rebound. So after and actually you heard Paul just now mention about the outlook on Sheng Siong. I think we are really waiting for this rebound. This buying level at 1.48 to 1.51 is a key crucial level to watch out for. All right, so the next one will be CapitaLand, and then Capital Integrated CICT. Okay. All right, so I think the consolidation candle remains above $4. So we are really waiting to break above 4.06 to confirm another upside for CapitaLand to achieve my first target price. All right, okay. And C380. And lastly, I'm going to share about CapitaLand Intercom. Right now, this is really a range about after it breaks off the descending channel within the larger rising wedge. Okay, so in my immediate target will be this island, this some sort of like island reversal look alike between $240 to $234. level. So there may be an upside break to 2.49 and then come swiftly down to reverse downside. So hence intra-mid period, I'm still very bullish on CapitaLand integrated commercial trust. Okay, so without further ado, I think completed most of the analysis over here. Pass my time, the valuable time to my colleagues. Over to my colleagues. All right, those will take answer. Thank you.
Natalie, you want to take anything? Up to you.
Okay, hi. I'll take the question on if you were to just buy one, which is a better REIT, Keppel DC Ascenders or Mapletree Industrial, all have DCs in their portfolio. Okay, so for this, just a bit of background on the three REITs that were mentioned. First of all, of course, would be Ascenders REIT. Ascenders REIT has about 10% exposure to data centers. Most of them are in US. Yeah, okay. Sorry, Europe, in the European data center. Also, of course, in Singapore. For Mapletree Industrial, their exposure to data centers is about almost 40%. And Keppel DC, as you know, currently still a pure play data center REIT. Okay. So in terms of coverage, we have coverage on Ascenders REIT as well as Keppel DC REIT, and we do not cover Mapletree Industrial. That's it. The kind of data centers that are held within the portfolio for Ascenders REIT and Mapletree Industrial, most of them are actually on the fully fitted or triple net lease kind of fully fitted triple net lease or shell and core kind of lease type. So what that means is that actually the amount of actual management of data centers is actually relatively low in comparison to Keppel DC, where 70% of their leases are actually in the co-location leases, which actually requires a bit more of active tenant management. Okay, and and the co-location leases are the leases that actually allow the operator to charge a higher rent on the space. Okay, so to the question of if you to just buy one, which is a better buy? Interestingly, I think Mapletree Industrial, just based on the kind of asset classes that you're holding, it will be sort of a blend of Ascenders REIT as well as Keppel DC. That's it. Our call for Ascenders REIT and Keppel DC, they are both an accumulate / buy call. And I think currently at the way the valuations look, we find that for Ascenders REIT, we like their diversification and their scale, and for Keppel DC, I think the renewed pipeline, of course, the 5 ROFO assets that were mentioned earlier, from after the post-acquisition of Guangdong Data Center would be something that could potentially drive growth for Keppel DC moving forward. If you were to buy one, which would you choose? I guess if you want even split between a REIT, rather between industrial and data centers, then you could go for Mapletree Industrial. But as I mentioned, Keppel DC is a bit different. They're not just they don't just own the data centers, they also have a large chunk of their operations where you're actually operating the data centers on its own. So you could also of course get a REIT and Keppel DC, which are 2 of our calls. So meaning that you, instead of buying one Mapletree, you can buy both, because Keppel DC does offer a different angle of things, not just the owner where you just rent out the space, and probably get good reversions, or rather step up maybe 2%, 3% over the years. But Keppel DC has the potential of, they can actively manage the asset coming in, conducting AEIs, and that helps to grow the rents. Yeah, and as you can see, earlier we mentioned in the first half of 2021, Keppel DC's first half revenue actually, or DPU, grew by about 12.5%. That was actually largely driven by AEIs and not so much the acquisition. So that is the potential. You don't have to actually go out there and put in additional capital to buy the asset. You can actually improve on the current asset and then reap higher returns. Yeah, so I think it just really depends on how you want to look at things. Okay, So that's all from me. There's some questions here about.
Yeah, go ahead, Natalie. I'll try and wrap it up fast.
Okay, some of the questions for REITs, I think I'll pass it on to Jie-Hui about Keppel REIT.
Okay, so for Keppel REIT, sorry, the video. Yeah, so for Keppel REIT, I mentioned the outlook earlier. Long story short, basically in the near term, the portfolio is stable. Leasing momentum for the Singapore office is likely to remain weak, but because KREIT's expiring rents are lower than passing rents currently, we will still be able to see positive rent reversions. We don't have any coverage on the counter, so we don't have a target price. Then I also take the question on CapitaLand China Trust. So the question is, what is the status of CapitaLand China Trust due to regulatory changes? So if you're talking about the crackdown on education, from what we understand, the exposure to education tenants within the retail portfolio is only about 3 to 4%. And if you look at the entire portfolio, including the business parks, this number is likely to go down to about 2 to 3%. And in addition, these education tenants are also more of the enrichment classes like dancing and singing, rather than those that are regulated by the policy, like more of the core curriculum, like your tuition. So relating to this crackdown, we think the impact on CLCT should likely be minimal. Yeah, so this is all for these two questions. I'll hand over to Paul to wrap up.
Sorry because we started late. So let me just try to quickly wrap up in 5 minutes. Whatever question remaining, I apologize for the delay because there were some scheduling issues. Is Del Monte still a good buy now after the Philippines lockdown? So just to re-emphasize the thesis, we don't cover, but let me just re-emphasize our view of Del Monte. Firstly, it's trading historically, number one, about 13 times PE. So most consumers can trade mid-teens to high teens. So that's number one. Number two is there's a turnaround in the US business, and it's only just starting. So that's the positive. And they also raise prices in the US, their products. Then number three, Philippines business is going for an IPO. I think the listing should be 27th of August. The pricing is about 11th August. So this could give some valuation numbers to how the consumer business in Philippines should be. And number four, the fourth reason is that when you do this listing and when the US turn around, one of the things, I wouldn't say plaguing, but one of the issues for Del Monte is the high interest expense, which is about 100+ million. So if this thing play out, the turnaround comes about and the Philippines get IPO, you can help reduce the 100 million kind of interest expense and the preference shares dividend. On the question of Philippine lockdown, there'll obviously be some impact, but I mean, I can't really quantify, but we don't think it will derail some of the five reasons we think the outlook is positive. In general, again, we don't cover, but we're just giving you some of the rationale we had, why we thought that was interesting on Del Monte. Okay, let me just try this out. What could the impact Thai beverage estimated target price in 3 to 6 months time? Okay, for Thai beverage, the impact won't be felt in this quarter. I think it will be felt in the third quarter because most of the lockdowns only I think is going to be happening more on the third quarter. And also more important, a year ago, if you recall, in April 2020, there was a 1-month ban on alcohol. So for this quarter results, you won't get that. So number one. Number two, for Thai beverage, a lot of the consumption is not in Bangkok. So most of the restrictions now in Bangkok, but their main, 90% of the profit, 80-90 roughly, comes from the spirits business, which is from the farm, which is consumed by farmers and not in the urban areas. And a lot of the urban workers actually went back to their farms and so because there's no jobs in the cities, right? So there will be some impact, but it won't be so like, I don't think it'll be like a big 20-30% drop because of that. And number three, Thai Bev has been very aggressive in cutting E&P spending to cope with whatever revenue number. So that's why we think it could surprise. I mean, not to our estimate, but I think it can be quite resilient in our own view. Sorry, I'm just rushing through. We don't have much time. Okay, I think there's still a few more. I'm sorry, because I think Varen, you have yours is 5 minutes time, right?
I actually pushed back to 1:30 actually, so you can take your time.
Oh, okay. Then let me just try. Okay, the other thing is someone asked, is your target, FYI, the target price and rating of ART on Paul's model portfolio and Natalie's slide do not appear to be the same. Yeah, I think mine is wrong. Yeah, so sorry for that. It was my error on my side. Probably I didn't update it. So thanks for highlighting that. Okay, what else? Is SPH still a good buy now? We don't cover, but I guess now you got an offer out there, so it doesn't hurt. I mean, worst case, there's an offer out there at $2 and I don't know, $2.10 on paper. And yeah, so who knows, there could be other people looking at the asset at SPH too. Okay, okay, any other? Okay, this one, hi Paul, can you share your views on Hong Kong and China stocks due to the government crackdown? Is it time to bottom fish or more downside? I really know, I mean, China, Hong Kong, China, I really no idea. It's going to be hard for me to answer that. So sorry, yeah. Especially when this is recorded, so I can't really help you on that. GS, okay, and the next question, does that mean that First REIT will have a higher DPU and there's a tendency that the price will go up? Actually, there is in October, the very unusual thing is that because they can only revise that 4.5%, the annual escalation, once they get the audited accounts of the hospitals. I know it's a bit confusing because it's higher off, right? It's you either raise 4.5 or you get a percentage of turnover, but you do not know the turnover until you get the audited accounts. So they can only do it in October. So in October, they will check both and see whichever is higher. Then you will get that 4.5. So the numbers on theoretically should be better in the second half than even in the first half because of the 4.5% escalation. But the caveat here is that all the revenue is in Indonesian rupiah. So you are taking Indonesian rupiah risk. So that is the offset of it. But historically, if you go and track Indonesian rupiah versus Sing dollar, the annual weakness or the annual depreciation of the Indonesian rupiah versus Sing dollar is roughly about 2%. Again, annual, sometimes can be 3, 4, sometimes plus, but so that 4.5% historically speaking does cover it. I mean, again, it doesn't mean it won't depreciate more, but the 4.5% compared to the historical annual depreciation of the rupiah to Sing dollar of 2%, there is some cover to it. GSS, what's the impression of GSS? Sorry, I don't really have, don't really follow. Okay, an observation, how come Star Hill REIT rose so much? Not sure Natalie or Jehui can help. Okay, Natalie, Jehui, do you have anything on Star Hill? Okay, anywhere to see the first slide? The next question, anywhere to see the first slide which lists down the companies covered today? Yeah, maybe we can put it up, but if you want, we actually have a recording, so you can watch it on the YouTube too. I think we will have a recording of that. Okay, how's the outlook or SIA? Not very sure. I didn't really go through the. Okay, this one on banks. Yeah. Terence, not sure if you can take that. Is technical or is it a fundamental question?
Oh, yeah. Let me take the question of the bank. The three big local banks are reporting this week. What's your comment on their stock prices going forward? So we think after the major news on the three local banks is the removal of the dividend cap. So that's going to be positive for the three banks. So I think, but the share price is there's no rally in the share price. It's moved up a little bit, but it's not really a lot. Mainly because I think the people are still waiting to see, investors are still waiting to see their 2Q21 results. So post the announcement of the 2Q21 results, we continue to expect to be strong, mainly because their earnings are expected to improve from FY20. Then we think that there will be a re-rating the share price of the three banks. We also think that a potential special dividend announcement is likely that the three banks may announce, especially DBS and OCBC in the near term. So this could see a re-rating in the share price of DBS and OCBC post results announcement. Yeah, I think that's all.
Maybe I do a last one on, I think on the, let me see, the Keppel Corp, and then Japfa, and then maybe some of the like Meituan and Dairy Farm. But okay, Dairy Farm maybe not, because I think Dairy Farm is like mostly on the downtrend. Just look at it like last week. All right, so without further ado, I think I'll just look on the Keppel Corp. Okay, so Keppel Corp has been performing relatively well. The pattern actually plays out quite well. Price stays supported. This is the trajectory line that I drew based on 5th July, the start of last month on July. And then double testing, divergence, not really divergence, but there's like some sort of like one last push up, and then price has a suspension gap this morning, forming some sort of like doji-like pattern right now. So let's see how it's going to perform later on wait, this okay, this last Friday, so sorry. This gap, and then I think let's see how it's going to perform like later after it clear off the suspension or some trading halt thing, but it's right now at resistance, so we're not sure on how it's going to perform. But generally, I think Keppel Corp is on the upside to test $6 to $6.10 going forward. All right, the last one, maybe the second last I'll do is the Japfa is on a very strong downtrend. Let's see on support zone 2 whether it is going to be a strong rebound after that. All right, it has been going on a strong downtrend. Let's hope that it's not going to be a death cross over here. All right, so Meituan, like what I shared earlier on, like Tencent, Alibaba, I think it's the same. The death cross already been formed. First of all, I think it is faced some correction at a major support turn resistance at 234 to 252.4. All right, so yeah, we are going to see whether there's a strong upside or not. All right, thank you. So let me see any a few more one. I think there's a prop next question. Prop next upside, but I think that we are facing some sort of like correction consolidation. So hence, not sure that we are. I'm not sure about the direction, although it's still going on the uptrend. All right. Thank you. So I think that's all. So much. That's all for now. All right. Any question? Just post it. Just drop us email or something. Paul, anything back to you?
Yeah. Okay. Let me just answer this. Sorry. Natalie, you have anything you want to?
Okay, I'll just touch on the question on Starhill Global. We don't cover Starhill, but I think our suspicion is that the rising in share price could be related to, apart from their AEIs in their portfolio, potential AEIs. As you know, Ngee City actually contributes a relatively significant percent of their portfolio. I don't have the number with me right now, but it is one of the largest assets within their portfolio. And within the Ngee City asset, there's of course this luxury fashion hall, comprising of very big names like the likes of your Chanel and all your other branded luxury high tier kind of brands, which we know there has been a little bit of improvement, or rather compensation of domestic spending towards these categories, and I think in their recent results, we see that the recovery in the retail portfolio, namely the Ngee City and Wisma, has also improved about 27% thereabouts. So I think in general, it is just off a lower base. Yeah, and it could be the positivity from I guess luxury benevolent spending. Just a speculation. Yeah, thanks.
Okay, let me answer this last one, then I think we can end it. Since we talked about coal earlier, this question is Golden Energy and Geo Energy, which is a better buy, please? The last time we checked for Geo, I think the PE is probably like 2 times PE or 3 times before this thing, before the recent increase in price. This is based on when coal price was, I think last year's first quarter's coal price, and we know coal price has increased. But for Golden Energy, what you can get is, I think the numbers that's going to come out is going to be very good for the coal companies. I think because number one, I'm just talking about Golden Energy. Number one, the coal price, because they got thermal coal, so thermal coal price year on year for second quarter, I think doubled, or maybe 90% roughly. So, and then number two, their volumes are going to increase by 20%. So you're going to have price increase by 90% and then volume increase by 20%. And then number three, Golden Energy also sells met coal, which is the coal used by steel mills. That the price for steel mills, because that's Australia, initially was down because of the ban, the so-called restriction. But I think recently, met coal from Australia, I think doubled. Last year was about 100. I think now it's about 200 plus. So so basically, their pricing for all their products just doubled. So it looks like Golden Energy. The only thing for Geo is maybe the acreage may be a bit smaller than the rest. So, but it's still a net cash company. I'm not really giving a clearer answer, but both I think going to have very good results because of the spike in coal prices. Okay, I think with that, I think we probably need to end. If there's no other questions, if you do, please send them in. Someone asked us about the Straits resources. Sorry, there was a webinar that was cancelled. That's why we couldn't comment on that. So sorry for that, because the company last minute cancelled the LISCO webinar. And also next week on the 9th of the National Day, so there won't be any webinar, 11:15 webinar. So so with that, I think we should conclude. And thanks everyone, and stay safe. And thank you so much for your time. Hope you have a good week ahead. Thanks everyone. Take care. Bye bye.